What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team, recently ranked #1 on Wall Street in the 2024 All-America Institutional Investor Research Survey. I'm joined by Stephen Gregory, Head of Quantitative Research at Piper Sandler.
Hello, Michael. Good to be back again. I wasn't on last week, so what's going on with you? What's new?
It's August. I like to refer to August as the Sunday of the calendar.
I love
Because
that.
I don't know, there's just something where I don't know, because you have kids that are in school, as you do as well, and so all the back to school stuff starts. I was in Walgreens this weekend, and they had Halloween stuff, like Halloween candy. Is that candy even good by Halloween? That seems like a little bit early of a pre-order. It was a little bit depressing.
I agree. That is shockingly early. I don't know if I would want candy that's been sitting. I know it's all the candy's probably been sitting on the shelves even longer, but just psychologically, I'm out on that.
Yeah, but August usually flies by, just like Sundays usually do.
Mm.
So it's a busy time. We got earnings, right in the thick of earnings. I think we've had about 400 names or so in the S&P 500 report. Overall, I think the headline is most companies beat, as they typically do. I think this quarter we saw maybe a little bit of an unusual decline in estimates leading into the quarter, making the bar a little lower. So I think that's part of what you're seeing. But I saw a stat, and I've just been seeing single names. If you've missed this quarter, the last 3 weeks, man, if some of these stocks down 30, 40, 50%. And I think we have this interesting setup going into the quarter, something we've talked about in our work the last few weeks, where you've had this huge macro rally, this huge relief rally, not due to any company's specific fundamentals or earnings, but really just due to the market pricing out tariff risk, pricing out inflation risk, pricing in a rate cut now pretty much locked in September. I think current odds for September cut are 90%. So, all right, they're a little lower than where they were yesterday, 94%. But the market's really kind of pricing in this Goldilocks environment. And so you've had this run up in stocks, largely multiple expansion, which kind of creates this risk. If you miss earnings, your stock's just been up a lot, kind of leaving a lot of downside risk. So I think we've seen that a lot. While again, the earnings season is overall, I'd say good, there's just been some pretty big blow if you've missed.
Yeah. So for companies, it's been kind of Goldilocks coming in, and any bad news has just been disastrous for these names. And that kind of seems like, is the market itself in aggregate set up for the same?
So yeah, the overall market is, again, the indices are doing fine. They keep going up. And you've got this, after that really weak payroll number last week and the big revisions, you've got a rate cut priced in now, 90%. So that's just another macro part of the story that, the market's just taking hook, line, and sinker. So, if we get a backdrop where we don't get a recession, we get a few rate cuts, and inflation, and I want to talk about inflation because that's coming up next week, doesn't increase, that's a pretty good backdrop for equities. So that's what the markets are reflecting now. But I think it's important to, we saw this in earnings season, and I think we've seen this with the macro data. It's important to recognize that with a lot of uncertainty and the general tone in things, certainly glass half full since the April lows, the market basically, in the absence of a problematic data point or bad earnings report, stocks are moving higher. And I think that's how things typically work when the market's been in a rebound. If you're in a good mindset, you typically extrapolate that, and vice versa. I'd say we had the opposite backdrop, the first 3 months of the year. So I think the market's kind of doing what it typically does, or really, the market's just a bunch of investors and people. And right now, glass half full until proven otherwise. So single stocks have been proven otherwise if they've missed earnings. For the macro story, next week, I think CPI is going to be an interesting day, August 12th. And, you and I have worked together for a long time, and we rarely make short-term calls and focus on one data point. But I think the CPI reading next week is going to be a kind of a make or break data point for a lot of stocks. And if it's potentially a big outlier one way or the other, then, for the whole market, it could be a great day for the market, could be the end of the, at least near-term Goldilocks vibes that the market's been enjoying for a little bit here. So a data point we got this past week was in the services ISM, the prices paid index, and it went to a new cycle high. So basically the highest level in a couple of years. It didn't eclipse, of course, what we saw in 2022, but it's at 70 now. And I think what people don't often understand about how PMIs and diffusion numbers work is that they're compounding on each other. So for example, the prices paid for the services space was at 70. That's a really high number. 50s, no change. 70s, a big acceleration. Last month, it was like 68. The month before that, it was 69. So I think what people don't realize is that these are cumulative numbers. So this month, how did things change? They went up a lot. You ask the same question in a month, how did things change? They went up a lot. And then the same thing again, the third month in a row. So we have to understand that you've gone from point A to plus another increase from that point, plus another increase from that point. So 3 months in a row of services prices reading at near 70 is a pretty big red flag for inflation. So I don't think it's really useful in telling you where CPI is going. Can we create a point estimate? But I think it's pretty loudly telling us that CPI is likely to incrementally move higher. And the thing is, we're talking about tariff risk, but this is showing up in services, which is not the direct impact of tariffs, which suggests also that there's perhaps more pricing pressure than just the tariff goods issue. So I think this is becoming a pretty broad focus on Wall Street. We've been talking about this for 3-4 months, kind of leading into the CPI report. I've seen it on Twitter a bunch. Some other firms I've seen have published the same chart. And so right now, I would say the market's really not pricing in any risk of CPI coming in hot. And again, going back to what I said earlier, it won't price that in unless it happens. Market's very reactive. But I think even another increase in the headline number from last month, which was an increase, I think CPI went from 2.4 to 2.67. And I would say it's probably going to go higher this month and the next month. It just, I think, complicates the current view of the markets, which is we're going to get a cut in September, probably going to get a cut in October and December too. And I'll just wrap this last point. What's interesting, if you look at the odds of rate cuts in those next 3 meetings that are left this year, they all saw a pretty big change on the employment report. So the odds of September went up a lot, October and December, which I think is a good way to show or demonstrate the point that we often make is the market's not that forward-looking and often tends to extrapolate the present. So in other words, because of one bad employment report, the market's forecasting out into the future that we're going to get more bad employment reports. So we'll probably get a cut in September, perhaps in October, and perhaps in December. And now if we get a hot CPI report, all 3 of those numbers probably get pulled back as well, because again, it's just extrapolating the present. So that's kind of how we're seeing things here. And we think you want to be lightening up on risky stocks, especially those that just kind of rose with the rising tide of macro relief over the last 4 months heading into that report.
So CPI next week could challenge a bit of the price for perfection narrative that we've been seeing for overall markets. But you bring up an interesting point right there in terms of the rising tide. So we've seen a sharp move higher in markets, and typically those sharp moves higher are led by smaller caps. But once again, you send it around this week, the Mag 7, it is an all-time relative high.
Yeah, the Qs relative to the IWM, large S&P, Mag 7. Yeah, it's pretty stunning that you've seen one of the sharpest market recoveries and beta recoveries, plus all the speculation you're seeing in these, individual names from meme stocks to crypto to other areas of AI. So there's certainly plenty of speculation in the market. I think there's another fart coin. So the small caps, of course, did go up, not nearly as much as the large cap tech stocks, but they didn't go up more than the S&P 500, which is pretty unusual. But I think that the reason small caps did not outperform because the market, I would say, was really more worried about growth. And with the rebound in the markets in April and some of the data thereafter, you saw interest rates move higher, not lower. So you got a rally in equities, you got relief from a recession fear from all the tariffs and the downturn in the market in March and April. And pricing out recession means rates should go higher. And rates going higher, I think, was a bit of a headwind for a lot of the stocks in the Russell 2000, at least on a relative basis. This is very different than what we saw, for example, in beginning in October of 2023 and November and December of 2023, where I think the Russell 2000 had the fastest move from a 52-week low to a 52-week high, and certainly outperformed large caps and tech and Mag 7 in that period. But the difference, though, was that sell-off in the summer of 23 and rebound in December and November, that was really about just rates. It wasn't a growth scare. It was really people worrying rates were going to go up, and rates started coming down, and equities broadly bottomed and went up in November and December. And small caps not only got the benefit of that broad macro relief, but because it came with lower rates, it was even that much more of a supercharge for those rate sensitive names in the small space, in the small cap space. Whereas this rebound, rates really didn't move all that much.
So next week's CPI report, you probably don't want to be super overweight smaller cap stocks.
Well, yeah, I think so. And or rate sensitives, think about housing stocks, real estate, basically names that have, especially if they've bounced following the employment report, that day there were a lot of stocks that were up, and they were generally, I would say, rate sensitive names. And the 10-year, I think, got as low as about 418 as we're recording this now on Friday. And I've been watching it all week. The 10-year yield is creeping higher. It's back up to almost 428, without any kind of major data. So I think the market kind of overreacted a little bit to the weakness in the payrolls report. And perhaps we're not going to be crashing into recession now, and maybe rates overdid it in the short term. So a CPI report going higher could continue that unwinding of this recent rally in bonds, and perhaps, even just make the odds of a Fed rate cut go from 90% in September to 70%. And I just think just that alone could be a trigger for some rate sensitive names and more risky names to see a little bit of a sell-off. And I would include small caps with that. To me, because we continue to see small cap earnings not really improving in any robust or broad-based way. So, we continue to think that the bull case for small caps is Goldilocks, rate cuts because inflation's lower. And I just don't see inflation in the next 3 months coming in lower. And so how do you get rates lower? Well, right now, the reason the market's locked in a rate cut in September is because the employment report. It's not because inflation. So inflation, I don't think is going to help you in the next 3 months if it's moving higher. So do you really want to own risky names, assuming betting on rate cuts in September, maybe October and December? Well, the likelihood of that happening really depends on, again, either inflation coming in lower, which most data I see don't point to that, or you're betting on another bad employment report. But that's not really a good way it's not a good backdrop for riskier stocks, I think, at this point.
So more of the same.
Well, it's just we keep having these kind of reflexivity loops with rates and fear around growth, and then we bounce back to inflation. So, they're getting a little more short term, and there's a lot of volatility in sentiment, as we know, in the narrative, which is kind of one of our themes for the year. So one bad payroll report now, all this recession fear is resurfacing. What if we get a good employment report next month? And, the crazy thing, with the firing of the head of the BLS, who is in charge essentially of both the payrolls report and the CPI report, so essentially ahead of the data that feeds the Fed mandate, I think it's going to be really interesting to see who President Trump puts in that role, because if you think about it, effectively, he's trying to control the chairman of the Fed, and he's going to appoint a new chairman of the Fed. And the most recent consensus is that it's likely to be Waller, but that can change. And he's going to appoint a head of the BLS. So he's going to appoint the Fed and the person that gives the Fed the data that drives their reaction function. So
Interesting times.
So we'll see. Perhaps we get some upside surprises to payrolls going forward, which of course I think would be good for equities overall. But you get good payrolls and you don't get CPI coming down, it gets hard to price in more rate cuts, or even the current level of rate cuts out the next 3-4 meetings that the market is currently pricing in. And I think it's a short-term tactical opportunity to take off some risk off the table.
Super interesting, Michael. I think there's a lot to watch out for in markets this summer, which typically, quiet times, but not this year and not the past couple of years, actually. So we'll keep tuned to CPI and keep an eye on how sentiment is evolving. And I'm going to keep an eye out for Halloween candy at CVS. And quick fun fact, while you were talking, I looked it up, and my friend AI says that from manufacturing date, Mars and Hershey's candy is good for 1 year.
It's interesting.
So if you get that candy now, give it out in Halloween, and that bowl is sitting around Come 2026, time to toss it.
Yeah, I don't know. I do it anyway. I'd eat it anyway.
I need it anyway, too. Thanks so much. This was great, Michael. And to all of our listeners, tune in next week.
All right. Thanks. Bye, Stephen.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.